Good afternoon and welcome to the TheoTRADE afternoon video. I am Blake Young. Today is September 21st, 2023, and today we're going to look at sometimes picking stocks is obvious with a Visa and Tesla analysis. Now we won't stop at the Visa and Tesla. We're going to start with the SPY or the S&P 500. S&P 500 to recap some of the things we've talked about before, like we did in the main room at the TheoTRADE for the TheoTRADE members. We've talked about this head and shoulders pattern that's been developing over weeks and actually months. And with this development, we've now broke through the neckline. The expectation on this chart is that we should go from roughly, and I'm using the close prices, and I'm going to use the upward sloping, the higher upward sloping trend line as our indication of the breakout. Whichever one you want to go off of, this is the breakout, and the target's going to be somewhere between 413 and 410. Now, 413, 410 has still got some downside, but we've already overcome about 15, 20, 25% of the expected move in this head and shoulders pattern. The bearishness is intact, and as you can see, we are even closing at the lows of the day. Lots of pressure pushing on equities lower. Now, the move in the S&P 500 representing the broad market can be in and of itself a filter to help you pick stocks, help you pick trades. And with this, the bias is, the old adage is, I should say, a rising tide lifts all boats. And I've always expanded that to say, and a receding tide beaches all the boats. Statistically speaking, when the broad market is climbing, approximately 70% of all equities will rise with the rising market. When the market falls, however, 90% will fall with the falling market. So we're dealing with a push to the new lows, as you can see, even as we speak, in the last 5 minutes of trading. We're pushing to close near the all-time lows of the day and taking us back through here. We're looking at bearishness all the way back, erasing all the trading back into the first week of June. So we've erased more than 3 months worth of time. We've already seen the breakout and the acceleration. So just that bias alone would have us looking for bearish trades. But as you know, some of the things I like to look at, I like to look at home builders. I like to look at Visa as an indication of how consumers' behaviors are going to alter or change depending on the market. So before we get into our more in-depth analysis of Visa and Tesla, I do want to take a second and touch base on home builders. Home builders are showing us that we have some more bearishness here as well. Going to ITB, my preferred ETF, you can see that we've created a similar yet horizontal head and shoulders pattern. Left shoulder here, head, right shoulders over here, break of the neckline, re-break of the neckline, and the target and expectation we could look for is about 74. We're already halfway, about halfway to the target. So home builders are falling and real estate prices are falling and mortgage yields are rising. Some analysts expect it to be to 8% before the end of the year. That's about where I had priced it in. If we talked before, if we get to 5.3 to 5.5, then we would expect to see 7.5 to 8% mortgage rates. Now, 7.5 to 8% mortgage rates should drive all demand out of the market. We should see equities continue to fall and likely pull housing and real estate down as it goes. But Visa is my favorite to tell us whether we're just even buying stuff. Are we doing transactions? Now, Visa is different because we've had some interesting news come out over the last couple of weeks. If we take a look at Visa, I've got these gray lines in the background that's representing the annual monkey bars. Now, we barely broke above the annual monkey bars, came back, we're right near the 0%, so there's really not a lot of bias for the annual levels. I should point out that if we do break through 231, we could fall all the way back to 221, so there's some bearishness back down to 221. A 221 move from 250 would see about a 10% drop. A 10% drop obviously being significant, in Visa being the representation of consumer transactions. It's not consumer debt. We talked about debt in the previous weeks. Visa is not representative of consumer debt. Now, Visa was upgraded a couple days ago. Zacks upgraded it, a bunch of analysts upgraded it, and they said this is a good representation of what we expect from business transactions. In fact, we also had Visa and SWIFT, the payment processing for oil and throughout the world, that international transactions. SWIFT announced a collaboration to make international business-to-business payments go faster, quicker, safer, etc. That in and of itself should have been enough to lift Visa higher, because that should be a lot more transactions. But as you can see, that occurred on the 19th. That was the announced on the 19th, and Visa reversed, rolled over, and broke down. Now, my view on Visa is that if we can break through this channel, the channel low, that's another 17 points. 17 points below 233 would bring us down to 216, 215, somewhere in there. Now, that would be pushing us all the way down to test the annual low. Visa, again, is one of my canaries in the coal mine. When it drops, when it falls, when it moves to these new lows, the canary in the coal mine says if we are not transacting transactions, that means that businesses are not buying, it means that consumers are not buying, it means that transactions are not occurring, because they all ride the Visa transaction network. And we are pricing in none of it today. And as we watched, as we go into the end of the day, the S&P, the Nasdaq, they all traded down and near or at their daily lows and their 3-month low. This is a major sell-off. The sell-off has begun. Visa has broken out of this consolidation, and I would say we had a funny-looking left shoulder, head, and right shoulder through here. If you were to look at that consolidation, the target here should push us below the lows. And over the next couple of days, we should see Visa break out of its channel and be headed back down towards 215. Despite all the positive fundamentals, despite all the expectations of higher transactions, despite the upgrades, and despite the connection with SWIFT, we are not seeing the vote of confidence. We're not seeing the expectation of more transactions. We're seeing a slowdown. And this gives us opportunity to take trades short on Visa, like I said, for about another 10% lower move. And that could happen really over the next few days. Now, as we're watching the market continue to drift lower into the close or after the close, let's go back to the S&P 500 just so you can see the SPY hitting the low. You can see we ended the day just a couple pennies off of the low. The low was 431, the close was 431.23, close was 431.57. Since the close, if you want to look at the futures market and look at the moves through here, you can see that we're pushing lower here on the futures market, and we've now pushed to a new low, breaking out, and we should be seeing aftermarket reach probably down to 61 on the S&P futures. So we are likely to have a gap down on the market tomorrow. Jumping over to Tesla. Tesla's been trading in these little channels. You can see we traded here, broke out, traded here, we sold off, we returned back to the channel, tested support, tested resistance, and today we broke out and closed below this mid-channel line. Now this is a horizontal channel, and the expectation purely from a technical perspective is that we go from 260 down to about 245. 15-point move, about, let's call it 8%, another 8% lower. Which, considering that today was negative 2.6%, 8% is pretty easy. We get to hit that in 3 to 4 days. We might even hit it in 1 day, as the trend that starts during the week generally does not reverse on Fridays. The futures room, one of the things we look at is the trend established throughout the week generally does not reverse on Fridays. So we do expect some further weighing down of the market. Tesla's been a great representation or correlation to XLY because it makes up such a large component of XLY. If we look at XLY, you can see that we've drifted lower and we're at, I would say, at support. We broke out of the consolidation, broke down, we're at support. And as we've done before, if we take Tesla out of XLY, how bad is it? Now our ratio of 7 to 4 has altered a little bit if we could look back 1 year. So I've adjusted it to 2 to 1. 2 times XLY minus Tesla starts us out a year ago at near 0. You can see we opened right here, right about 6. But as you look at this, you can see the price pattern is still showing lower highs, lower lows, lower closes. We're drifting lower on XLY. We're finding this support level down near 60. And the correlation we've seen in the past is that XLY minus or taking out Tesla is pretty similar price pattern to what we've seen in Nike. The difference is Nike already broke out. Nike is accelerating to the downside. Even though we have earnings coming up, we are liquidating and running away from discretionary stocks. The reason why we want to look at discretionary stocks and talk about Tesla and talk about Nike is because this will again feed into the concept and the idea of whether we're going to see more or less transactions hitting Visa. So my canaries in the coal mine, the indication of what will change consumer behavior being home builders, because that will represent our value in our home prices, and consumer discretionary spending, and transactions with Visa, meaning just overall transactions, whether staples or discretionary spending, all are showing signs that there's weakness and the consumer's purchasing behavior is either changing or expected to change immediately. And the breakdown, the sell-off, and the continuation lower in things like Nike, and the sell-off that we saw in Visa, despite all the positive economic news and data, is confirming that we are seeing lower and lower transactions and a shift in behavior across the board. Just because we're seeing negatives in the market, negatives in the economy, does not mean there's not opportunities. What we are seeing is that as this is setting up, we are looking for weakness in these areas. We should see substitution into the staples, substitutions into healthcare, substitutions into utilities, as those are the defensive sectors. But we can also just take bearish trades, also sell call verticals, collect higher premium because volatility is on the rise. If we look at the volatility here on the VIX, you can see volatility is gapped up, closed higher, and now we're back to 18. We talked about this in the previous weeks. Low volatility. When the VIX is low, it's time to go. And I always say when the VIX is low and turns up, when it starts to rise, it's time to go. It's time to get out. It's time to look for short opportunities or bearish opportunities and collect premium as volatility gets higher. So if we get to the 18, 19, and 20, does not mean that you can't start selling verticals, defined risk trades, to benefit from this higher volatility and the next leg down in the markets. If Visa cannot hold us up, even with all the positive news and upgrades, then that is telling me that transactions have shifted and behaviors have changed. So if our transactions are failing and we're looking for safety, or I should say the least negative sector today was healthcare. And if we look at healthcare, you're going to see some of the few stocks that ended positive were in the healthcare sector, such as United Healthcare, or Elements Healthcare, excuse me, and CVS, Humana. These are some of the few that traded positive today, and they traded very positive, up and up and up. So we're seeing that shift away from consumer discretionary, which was the second worst performing, right behind real estate, and moving towards healthcare, utilities, and staples. The top three performing sectors today were healthcare, utilities, and consumer staples. So watch for that shift to continue. Watch for the safety play to move away from the higher risk, away from the leveraged, away from those that are going to have to borrow at higher interest rates, as we've reached a new annual high as far as the 10-year Treasury is concerned, and therefore borrowing rates are at a peak over the last couple of years. We have to go all the way back to 2007 to see interest rates as high as we have them currently. That is what you need to be able to see. That's what you need to be able to watch for as prices push up into these areas. The cost to borrow continues to move higher. If you like what I call techno-fundamentalism, using technical analysis and tying it to long-term fundamentals and economic principles, I would definitely encourage you to join us in Florida, a Trader's Paradise, November 2nd to the 4th. You can go to TheoTRADE.com/23. Make sure that if you are registered already, that you get your hotel booked. And if you're not registered, join us. Join us as we show you some new material that we've never shared before at this event. Look forward to seeing you there.